Preparing for a Federal Reserve Bank Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as an analyst at the Federal Reserve Bank? I want this role because it combines rigorous analysis with meaningful public impact. The Federal Reserve influences monetary policy, financial stability, and the resilience of the banking system, so careful research matters beyond a single company or portfolio. I enjoy working with economic data, testing assumptions, and explaining conclusions clearly. I would bring strong quantitative discipline, intellectual curiosity, and respect for confidentiality. Most importantly, I want to contribute objective analysis that helps policymakers make well-informed decisions under uncertainty. While answering, connect your interest in economics, public policy, financial markets, and data analysis to the Federal Reserve's mission, emphasizing intellectual curiosity, objectivity, public service, and the importance of rigorous evidence. Question 2. What are the Federal Reserve's dual mandate objectives? The dual mandate is maximum employment and stable prices. Maximum employment does not mean zero unemployment, it means a level consistent with the economy's structure and labor market conditions. Price stability generally means keeping inflation low and predictable, because unstable prices distort decisions and purchasing power. These goals can conflict temporarily, such as when strong demand supports employment but raises inflation. The Federal Reserve therefore evaluates broad data and seeks sustainable outcomes rather than mechanically prioritizing one objective. Make sure to cover maximum employment and stable prices, explain that the objectives can conflict in the short run, and mention the role of sustainable economic growth and balanced policy judgment. Question 3. How does the Federal Reserve influence the economy through monetary policy? The Federal Reserve influences economic activity primarily by adjusting the federal funds rate target and communicating its policy outlook. A higher rate typically raises borrowing costs, encourages saving, tightens financial conditions, and can reduce demand and inflation. Lower rates generally work in the opposite direction. Transmission also occurs through asset prices, exchange rates, credit availability, and expectations. Because policy affects the economy with variable lags, analysts must monitor leading indicators rather than rely only on current inflation or employment. In your answer, discuss the policy rate, financial conditions, borrowing and saving incentives, asset prices, exchange rates, expectations, and the delayed, uncertain transmission of monetary policy. Question 4. What is the federal funds rate, and why is it important? The federal funds rate is the interest rate at which depository institutions lend reserve balances overnight, usually without collateral. The Federal Open Market Committee sets a target range for this rate because it is a key anchor for short-term funding markets. Changes in the target influence treasury yields, commercial lending rates, mortgages, and other financial conditions through market expectations. I would distinguish the target range from the effective federal funds rate, which reflects actual transaction activity. Be sure to mention overnight interbank lending, reserve balances, the FOMC target range, and how changes in the rate influence broader short-term interest rates and financial conditions. Question 5. What is the role of the Federal Open Market Committee? The FOMC is the Federal Reserve body responsible for setting the stance of U.S. monetary policy. It evaluates inflation, employment, economic growth, financial conditions, and risks before deciding whether to adjust the target federal funds rate or balance sheet policy. The committee includes the Board of Governors and participating Reserve Bank presidents, with a defined voting structure. Its statement, projections, minutes, and press conference also shape expectations, making communication an important policy instrument. Focus on the FOMC's policy-setting responsibility, its composition, economic assessments, voting structure, communications, and use of data rather than a single indicator. Question 6. How would you assess whether inflationary pressure is becoming persistent? I would examine inflation's breadth, persistence, and underlying drivers rather than focus on one monthly figure. That means comparing headline and core measures, especially services excluding volatile components, and reviewing wage growth, unit labor costs, inflation expectations, and the share of categories rising. I would also separate base effects from new momentum and assess demand conditions. If inflation remains broad and services driven while expectations rise, I would view the risk of persistence as materially higher. Mention headline and core measures, services inflation, wages, inflation expectations, breadth, unit labor costs, demand conditions, and base effects, while avoiding conclusions from one monthly release. Question 7. Which economic indicators would you monitor when analyzing the labor market? I would monitor payroll growth, the unemployment rate, labor force participation, wage growth, job openings, hiring rates, hours worked, and initial jobless claims. I would also examine revisions and differences across industries, regions, and demographic groups. For example, strong payroll gains paired with falling vacancies could indicate rebalancing rather than overheating. I would avoid treating any single measure as definitive, because labor market data can be noisy, lagged, and revised. The objective is to identify the overall trend and sustainability. In your answer, cover payroll growth, unemployment, labor force participation, vacancies, wages, hours, jobless claims, demographic differences, and the need to interpret indicators together. Question 8. Explain quantitative easing and quantitative tightening. Quantitative easing involves purchasing securities, typically treasury or agency assets, to expand the Federal Reserve's balance sheet and influence longer-term interest rates and market functioning. It can reduce term premiums, support liquidity, and ease financial conditions when short-term rates are constrained. Quantitative tightening reverses that process through asset redemptions or sales, shrinking the balance sheet. I would distinguish these tools from the policy rate. QE and QT primarily affect longer maturities and reserve conditions, although expectations connect them. Make sure to explain asset purchases and redemptions, balance sheet effects, term premiums, liquidity, financial conditions, and why the impact differs from conventional policy rate changes. Question 9. What is the difference between the discount rate and the federal funds rate? The federal funds rate is the market rate for overnight lending of reserve balances between institutions, targeted by the FOMC. The discount rate is the rate charged by a Federal Reserve Bank on loans to eligible institutions through the discount window, particularly primary credit. The discount window provides a liquidity backstop, while the funds rate guides broad monetary conditions. In practice, the discount rate is typically set above the target range, reinforcing its role as a backup facility rather than routine funding. Be sure to distinguish the primary credit rate from the overnight interbank rate, explain the discount window, and discuss the discount rate's signaling and emergency liquidity roles. Question 10. How would you evaluate the effect of a rate hike on a regional economy? I would begin by identifying the region's economic exposures, such as housing, manufacturing, technology, energy, or government employment. Then I would assess how higher rates affect mortgages, business investment, consumer credit, bank loan growth, and local asset prices. I would compare local indicators with national trends and examine the timing because monetary transmission is delayed. A rate hike may slow interest-sensitive sectors first, while export-oriented or cash-rich industries could respond differently. The conclusion should reflect regional composition, not just the national average. Discuss the local economic structure, household and business borrowing, housing, employment, bank lending, financial conditions, lags, and comparison against national or peer region benchmarks. Question 11. How do you interpret an inverted yield curve? An inverted yield curve occurs when shorter-term yields exceed longer-term yields. It can signal that investors expect future policy rates and economic growth to decline, often because restrictive policy is expected to weaken demand. However, the curve also reflects term premiums, global capital flows, inflation expectations, and technical factors. I would therefore treat inversion as an important risk signal, not a guaranteed recession forecast. I would combine it with credit conditions, employment data, business surveys, and household behavior. Focus on the relationship between short and long-term Treasury yields, recession expectations, monetary policy expectations, term premiums, and the limitations of using inversion as a standalone forecast. Question 12. What is the Federal Reserve's role in financial stability and bank supervision? The Federal Reserve promotes financial stability by supervising certain banks and bank holding companies, assessing capital, liquidity, governance, risk management, and resilience under stress. It also monitors systemic vulnerabilities across credit, markets, and institutions and supports safe payment and settlement systems. This work complements monetary policy but is distinct from setting interest rates. Effective supervision requires looking beyond current profitability to concentrated exposures, funding fragility, operational risk, and how problems at one institution could transmit through the broader financial system. Mention supervision, capital and liquidity, risk management, stress testing, systemic risks, payment systems, and the distinction between monetary policy objectives and supervisory responsibilities. Question 13. How would you analyze a bank's liquidity risk? I would compare expected and stressed cash outflows with available liquidity over multiple time horizons. Key areas include deposit stability, concentration by customer type, uninsured balances, wholesale funding reliance, securities liquidity, collateral availability, and maturity mismatches. I would test scenarios involving rapid deposit withdrawals, market haircuts, and reduced funding access. I would also review contingency funding plans, governance, and reporting controls. A bank can appear liquid under normal conditions yet remain vulnerable if assets cannot be monetized quickly without significant losses. In your answer, cover funding sources, asset liquidity, deposit concentrations, maturity mismatches, cash flow projections, stress scenarios, contingent funding, and the importance of governance and reporting quality. Question 14. What is a bank stress test, and how would you evaluate one? A bank stress test estimates how capital and earnings would change under severe economic and market scenarios. I would review assumptions for unemployment, GDP, interest rates, credit losses, trading shocks, and balance sheet growth, then evaluate projected capital ratios and management actions. I would challenge model outputs with sensitivity analysis and benchmark them against historical behavior. Stress testing is not a prediction, it is a resilience exercise. Its value depends on realistic scenarios, sound data, transparent governance, and credible remediation plans. Make sure to explain adverse scenarios, projected losses, capital ratios, balance sheet assumptions, model limitations, sensitivity analysis, and the difference between regulatory and internal stress testing. Question 15. How would you use data to investigate an unexpected economic trend? I would first confirm the release, definition, seasonal adjustment, sample size, and revision history. Next, I would decompose the headline result by sector, geography, and component, then compare it with related indicators and alternative data sources. For example, a surprising employment decline might be tested against jobless claims, payroll tax data, vacancies, and business surveys. I would document competing explanations, quantify uncertainty where possible, and communicate a measured conclusion rather than overreacting to one observation. Focus on validating the data, checking revisions and definitions, decomposing the result, comparing sources, testing alternative explanations, and communicating uncertainty before reaching a conclusion. Question 16. Describe a time you found an error in financial or economic analysis. In a prior analysis, I noticed that a quarterly growth rate did not reconcile with the underlying monthly data. I retraced the formulas, checked the source file, and found that one month had been included twice after a data refresh. I preserved the original version, documented the issue, corrected the calculation, and informed my supervisor immediately. I then added a reconciliation check and a peer review step. The experience reinforced that accuracy depends on both analytical skill and disciplined process controls. Be sure to present a specific situation, explain how you detected and validated the issue, describe your communication and correction process, and emphasize controls, accountability, and lessons learned. Question 17. How would you explain a complex economic result to a non-technical policymaker? I would begin with the conclusion in one sentence, then explain the 2 or 3 drivers that matter most. I would use a simple chart or comparison, define technical terms only when necessary, and separate observed facts from interpretation. I would also state key assumptions and uncertainty, especially if the evidence is mixed. Finally, I would connect the result to the policy question, what it may imply, what it does not prove, and which additional data would improve confidence. In your answer, emphasize the main conclusion first, plain language, relevant context, limited technical detail, visual clarity, assumptions, uncertainty, and implications for the decision at hand. Question 18. What would you do if your analysis conflicted with your manager's initial view? I would first recheck my data, definitions, calculations, and assumptions to ensure the disagreement was substantive rather than procedural. Then I would present the evidence respectfully, explain the source of the different conclusion, and ask my manager to challenge the methodology. If uncertainty remained, I would show both scenarios and identify what evidence could resolve them. I would document the discussion and support the final agreed analysis. Independent thinking matters, but so do humility, collaboration, and institutional consistency. Mention respectful challenge, checking methods and assumptions, presenting evidence clearly, inviting critique, documenting conclusions, and supporting the final decision once the review process is complete. Question 19. How do you maintain objectivity when analyzing politically sensitive economic issues? I maintain objectivity by defining the analytical question clearly, using reliable data, documenting assumptions, and applying the same standards to competing interpretations. I distinguish facts, estimates, and judgments, and I present upside and downside risks rather than selecting only supportive evidence. I also preserve reproducible work papers and invite review from colleagues with different perspectives. In a central bank environment, the responsibility is not to advocate for a preferred political outcome. It is to provide accurate, balanced analysis that decision-makers can trust. Focus on evidence-based methods, transparent assumptions, balanced treatment of risks, reproducibility, separation of analysis from advocacy, confidentiality, and willingness to report inconvenient findings accurately. Question 20. What would you do during a sudden financial market stress event? I would prioritize facts, speed, and clear escalation. I would monitor market prices, funding spreads, deposit flows, collateral values, counterparty exposures, and payment system conditions while validating information across independent sources. I would identify potential liquidity, solvency, and contagion channels and quantify the most plausible scenarios. I would communicate concise updates with confidence levels, clearly separating confirmed developments from assumptions. I would follow established protocols and preserve documentation, because disciplined coordination is essential when conditions change faster than normal reporting cycles. Be sure to cover rapid fact-finding, market and institution monitoring, liquidity and contagion channels, escalation protocols, data quality, clear communication, and avoiding premature conclusions during uncertainty. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.